In this market update, I'm going to give an update of THOR's indicators. Jim Gore from THOR Wealth Management. Well, this is our quarterly update on what our indicators are telling us here at THOR. The first indicator is our THORdex, and this is looking at the equity market, specifically the S&P 500, if it is attractive or not. And right now, we are close to 76, right at 6. It's just slightly below it. And what our indicators are saying is that with the index at this level, and we're in the past when we've been in this, anywhere from 60 to 80, the returns on the S&P 500 over the next 10 years averages about 5.6%, which is significantly lower than what we've been all told that, hey, equities give you a 10% rate of return. Our indicators are saying, no, you're not going to get that rate of return. You're going to get in the neighborhood of about 5.5% rate of return. So what this is telling us is that the risk in the equity market is elevated still. Now, keep in mind, this is not a market timing tool to say, hey, let's get in, let's get out. It's all what we're trying to do here at THOR is trying to get the highest rate of return with the least amount of risk. When the risk is high like this is why we don't have 100% invested in equities in our portfolios or up to the target, except for our best ideas, which is always invested in the equity market. The next thing that we look at is fixed income. And we look at two indicators here. First is duration. Do I want to own a 1-year bond or do I want to own a 20-year bond? Duration is how long you're going out. And so duration means that you're adding on duration, you're adding out, you're buying longer term bonds. Credit is if we were going to buy a treasury which has no credit risk, full faith and credit of the US government, or do I buy, let's say, a junk bond or a corporate bond that may not be able to pay me back? So right now the indicators are saying duration is about 1.25. So duration, you still want it in your portfolio. Credit is a -2. So this is not a time that you want to lend money out to companies or institutions that may not have the ability to pay it back, because it's going to be a little bit more difficult in the future for them to do so. Now, what's interesting is these indicators have moved quite a bit in the last 4 years. If you look back at January of 2021, the duration was a -2.5%. We had no long-term bonds at that juncture. And it benefited our clients back in 2022 when we actually saw the ag was down over 13%. It didn't make sense to us to go out and buy 10-year treasuries yielding 0.8% or 30-year treasuries yielding a little bit over 1.5%. To us, that was risk, and our indicators were showing that. However, last year at this point, the duration was a positive 2.5. And so we were actually adding on duration into the portfolio, and we actually added some fixed income to our 100% equity accounts because of that. And I'll talk about the next chart, what we were looking at there. But with a 2.5 duration, it was time to get a little bit longer. And we did get longer in all our clients' portfolios. We are not shortening up because our indicators are still showing duration is positive. When that goes negative, we will take duration out of the portfolio, just as we did back in 2021. The last chart is something that we look at is whether equities or fixed income are more attractive. And this is looking at it from a risk return perspective. Keep in mind, bonds do not fluctuate as much as equities. Our THORdex, what we're looking at is about 5.5% rate of return over the next 10 years annualized. So it's much lower than the 10% rate of return. Our indicators are showing that fixed income is more attractive. It was a little bit more attractive back a year ago, but it is still more attractive than the equity market. And so that is why we have less exposure in our equity portfolios than our target, except for our best ideas portfolio, which is always 100% invested in the equity markets. As always, if you have any questions or concerns, give us a call or reach out to us at THORwealthmanagement.com, especially if you are looking for an active manager who will monitor the risk in your portfolio and lower risk when it's appropriate and add on risk when we deem it's appropriate and what our indicators are telling us. Take care and look forward to talking to you in a couple weeks.